Hi there. Welcome to The Open right here on BNN Bloomberg. Let's get to those big stories we're bringing you from the newsroom. Canada's economy posted modest growth in February. StatsCan says GDP rose 0.2%, in line with expectations, following a smaller gain in January. The increase was driven by strength in goods-producing industries, including manufacturing. Early estimates suggest growth stalled in March, though the economy did still expand in the first quarter overall after a contraction late last year. CP Kansas City posted Q1 results that missed expectations. The railway reported lower than expected earnings, with revenue also slightly below forecasts. Freight revenue actually dropped from a year ago, reflecting weaker shipping volumes and pricing pressures. The company says it continues to face economic headwinds. Meta shares dropping 8% in the pre-market after the company raised its AI spending outlook. The tech giant now expects significantly higher capital expenditures this year. The weakness in the stock comes despite first quarter results that beat expectations on both revenue and profit. But investors are focused on the scale of Meta's spending as the company builds out data centers and invests heavily in AI infrastructure. So U.S. futures actually pointing up at this stage, despite the disappointment over Meta's continued massive spending on AI. Let's see how the TSX traded yesterday. Our market got something of a boost from higher oil prices, but selling in the U.S. was a cloud over our market too. Let's have a look at oil, see how it's doing this morning. It has taken a breather, although we've seen prices near 4-year highs. And let's have a look at gold. Gold up slightly today. And the loonie, the Canadian dollar, let's see how it's faring after both central banks on both sides of the border stuck with their interest rate policy. And finally, Bitcoin, the biggest crypto, and it is holding its own today, up about 1%. We have a tidal wave of earnings today, including the tech heavyweights, or some of them, Alphabet, Microsoft, and Meta. And we're also checking out the results from Bombardier, Gildan, and CP Kansas City. Let's get more from Lawrence Steinberg, co-president of Lawrence Steinberg Wealth Management. Great to see you.
Andy, great to be here with you.
Thanks for coming into the studio. Give us your take on these tech numbers. It's not a new theme. Investors have misgivings over the massive capex on AI.
They certainly do. The tech numbers are spectacular. Let me say, to have companies with $300 billion of revenues growing at 19%, like Microsoft, and 17% or so like Alphabet, actually 17% for Microsoft, 90% for Alphabet, and Meta, 33% revenue growth. It's just absolutely unheard of. It is spectacular. Of course, the issue for a couple of these companies is the AI spend. Meta will spend $325 billion between this year and next.
Wow, $325
billion, and will have negative free cash flow, therefore, this year and next, which is unlike most tech companies. Microsoft's basically spending all of its cash flow. And so, when we look at Meta, and we reduced our position in Meta earlier this year, our view is Meta, Mark Zuckerberg seems to be the mastermind, behind everything. Whereas when you look at Microsoft and Alphabet, it seems to be more of a, broad-based executive suite. Mm-hmm. That's just the perception. Microsoft, we love it. Microsoft remains at the nexus. They are the major vendor, IT vendor, and for every major company. Alphabet, it's ad-based, and it just keeps on gaining market share, but Meta does too. And, our view is that these companies are not just wasting their money. They're building out data centers to meet demand, and so far demand outstrips supply. Mm-hmm. So we do like all of these companies despite the spend.
The Wall Street Journal is a little skeptical here. Heard on the street today. It says these tech executives are like graduate students running up credit card debt, certain their lucrative careers will pay off.
Well, I have to say this. So Microsoft, as an example, is spending 190 billion. That's up about 30 billion simply because chip prices and other items have just risen in price. But Microsoft is doing this to meet demand that is already there. So a lot of this stuff is, basically pre-sold. They will make a profit on this spend. I think the question is, will they be able to keep their margins up on all of this money they're spending? And that is a valid question. That being said, these stocks have sold off. Microsoft is maybe 26 times earnings. It is, for us, compelling. It's growing at over 15% a year. Alphabet, roughly, 25 times earnings, growing at roughly the same. There are very few companies in the world growing at these kinds of rates.
And they're massive, as you note already, Lauren.
And they are integral to everything that us as consumers and that large companies do. We need these companies. Like they are the giants.
So certainly Microsoft and Alphabet would be two techs that you would favor owning.
We do. Meta, we reduced our position, but I have to say, it's 33% revenue growth. This is an astounding number. They're an ad-based company. And part of me says, hey, they're gaining market share, obviously, because ad spend is not growing anywhere. It's growing at, low to mid-single digits. So they are doing something very right. You hope they have the capital discipline.
Yes, and eventually rein it in. Let's walk through some Canadian earnings. CP Kansas City is a stock you own. There was a slight miss.
Sure, there's a slight miss, and we're seeing somewhat the same thing on the Canadian National Railway side as well. CP Kansas City, the real issue, first of all, is it's on the shipping side. It was the coal revenues that were down 12%. That's the main issue that impacted revenues. On the earnings side, where there was a slight miss as well, there was that. So their operating ratio went down. And
is that a good thing? Just remind us.
Right. So the operating ratio actually went up. So in other words, their costs went up versus every dollar of revenue. So they're making less money.
Yeah.
And the second thing is, of course, they're dealing with fuel price volatility, which is an issue. But the real overhang, because we like both CPKC and we also like Canadian National Railway, the real overhang is, of course, what's going to happen with the free trade talks that are coming up. For sure, economic uncertainty is a negative for both companies, but the overhang is the free trade agreement, and where does that end up?
Longer term, though, you're an owner of the two
Longer
big
term,
Canadian
we really like both,
rails.
and I'll tell you, with the sell-offs in these companies, the valuations are very cheap.
Oh, okay. What about Bombardier? Fascinating company, obviously, but in a way, when the global rich do well, they do well. It's not all millionaires buying the planes, I know.
No, but Bombardier really is now purely a private jet and private jet servicing business with the defense, division as well, which is growing. And, they delivered 24 private jets this quarter versus 23 last time. So people are still buying private jets. A lot of them are sold for people who buy portions of a jet.
Right.
But the servicing business is flying. It's sorry, I shouldn't even use that pun. But I didn't mean to. But the servicing revenues were up sharply. Most importantly for Bombardier, because they've been an indebted company forever, is their free cash flow should surpass $1 billion this year. And ultimately, that's going to drive this company, and it's going to drive valuation, because that's been a huge negative issue for this company forever.
What about Gildan? Would you stick with them? It seems like a classic staples retailer.
Sure. So we don't actually own Gildan at the present time. Now, this is the first quarter. Gildan bought Hanes last year.
Oh, massive deal. Yeah.
Exactly. So this is so don't look at the revenue growth of 60%, because it's meaningless. This is the first quarter with the Hanes fully into Gildan. We're taking a look at Gildan. One thing we do like is they're going to achieve their $100 million of synergies this year. They're going to probably achieve the $250 million of synergies over the next 3 years. Seems to be a very well-run company, and this looks like this acquisition truly was accretive to earnings on day one, unlike so many acquisitions. So, it looks like they bought Hanes at the right price. There'll be no share buybacks for the next couple of years because they took on a lot of debt to do this deal. So their debt to EBITDA is 3.3 times, and they want to get it down to 2.5 times before they even look at share buybacks.
I noticed an odd thing. I was in Michael's, the big crafts chain, and I was looking at T-shirts because they sell them for people to print on, and they were Gildan T-shirts, really cheap. It looks like it's a cheap place to buy T-shirts, Michael's.
Keep that in mind.
Lauren, thank you very much. And so I've been interviewing you for years. This is my last day. Thank you very much.
Annie, and I'm truly honored to be here. On behalf of everybody who's watched you, a big thank you.
Oh, Lauren, thank you very much indeed. Lauren Steinberg, co-president of Lauren Steinberg Wealth Management. Coming up, today's the deadline to file your 2025 income taxes. We'll tell you some of the things you need to know when we come back. Canada is the first G7 country to approve a generic version of Ozempic and Wegovy. Now, many are looking to see what this approval will mean for those living with diabetes and obesity. CTV's Geneviève Beauchemin filed this report.
Months after Ozempic's patent expired, Health Canada has given a generic the go-ahead. And the approval of India's Dr. Reddy Laboratories' copy has been applauded by many patients and advocates.
And there hasn't been a whole lot of options available.
Obesity Canada's Eaton Patton says for him, semaglutides have been life-changing.
I had this voice in the back of my head always chirping at me, talking about with that uncontrollable food drive. And having a treatment that allows me to gain control has been very, very impactful.
Like Ozempic, says Health Canada, the generic injection is indicated for the once-weekly treatment of adults with type 2 diabetes. But around 3 million Canadian adults currently take medication like Ozempic for diabetes and obesity. Still, doctors say some patients who would benefit steer clear because of money.
You might not be able to have access if you didn't have the economic means or the right plans. So I think it increases equity.
The drug costs about $228 a month. Health Canada says many generic medications are 45 to 90% cheaper than the brand versions. And that price could go down with more generics on the market. Health Canada is reviewing 8 other submissions. That could also reduce expenses for provincial and private drug plans deciding to cover the generic. Experts applaud accessibility but also warn against minimizing potential side effects.
This is a drug. It's not a candy. It's not a supplement. It is a medication.
The generic dosage approved now is for the treatment of diabetes, but advocates are watching to see what other generics will come and what the impact will be on the costs. Geneviève Beauchemin, CTV News, Montreal.
Okay, tax time's nearly over. You have until the end of the day to file your 2025 income tax return. Self-employed people, though, have until June 15th. CTV's Scott Hurst has more on the deadline and what Canadians actually can do with their returns to send them in.
Andrew, good morning. Still hours left to the deadline at the end of the day today. So lots of time, of course. It might be daunting if you have not yet gotten to it. But of course, it can be beneficial as well. Let's dive into some of the numbers. Last year, Canadians filed more than 33 million tax returns with, according to the CRA, 93% filing online. In fact, more than $45 billion in refunds were delivered last year. That, of course, is the benefit. According to the CRA, Andrew, taxpayers received an average refund of about $2,000. That money coming back to you to use however you want. Now, in terms of filing this year, the CRA says backlogs and delays are being addressed. It claims responsiveness has doubled. That's in part, it claims, with the help of AI-driven modernization with more tools than ever, it claims, to file, including service enhancements that have been made to make it easier to recover credentials, track your return or refund, and pay a balance. As you mentioned, today is the deadline for most. For those who are self-employed, you have until June 15th.
And so millions of Canadians likely to get money back. And as you say, the average refund, about $2,000. Experts say don't blow the money.
Yeah, of course, it looks very promising when it shows up in your account, but experts say try your best to put most of it toward debt or savings while setting aside a smaller portion for maybe some guilt-free spending. And a recent survey by EQ Bank found only about 9% of people expecting a refund plan to spend on discretionary items like travel or dining out. Also, paying down high-interest debt is another good option, like lines of credit or credit card debt. As another recent survey, this one by Viva Data, suggests about 36% of Canadian credit card holders typically carry a balance. Other options, potentially tax-free savings accounts or RRSPs. Another suggestion from experts is if you haven't already set up an emergency fund, particularly right now, as we know, job security is so much of a concern for many of us right across the country. And emergencies, of course, can come in many different forms. So still hours left, if you haven't got to it yet, for most people to file their taxes, Andrew.
Thank you very much indeed. For once, mine are in. I'm actually organised. CTV Scott Hurst. Thank you very much indeed, Scott.
Thanks, Andrew. All the best.
Thank you. Okay, big tech companies reporting last night. The verdict from investors is split. Which companies are reaping the benefits of AI and which ones have investors worried? That's ahead. We got numbers from Meta, Alphabet, Microsoft, and Amazon last night. This comes just days after news that OpenAI is missing its own revenue targets, and that shook confidence in the whole AI trade. Now, these four companies are set to spend hundreds of billions on AI this year. Let's get more from Brent Thill, AI software and internet analyst at Jefferies Research. Thanks very much indeed for joining us.
Thanks for having me.
Walk us through the individual companies, if you would. Start off with Meta, because apparently it seems like this recurs every so often with Meta. People are worried about the spending, and this time on AI.
Yeah, that's right. I think what shook investors is that the guide for Q2, which again, remember, Meta is an advertising business. They're very different than Microsoft, which is a subscription enterprise business. So you saw kind of a concern around the ad business as well as the investments in AI. And I think when investors are looking across these big four companies that reported last night, they have higher conviction in what Amazon, Microsoft, and Google's ROI and what they're spending on AI. When you look at the Meta portfolio, they've had their first wave of AI, which improved Instagram, the core Facebook site, WhatsApp, many of these properties. I think the next wave of AI investment, everyone believes that it may be riskier and therefore the ROI may be fuzzier. So therefore they're discounting the stock and not convinced like they are in some of these other names. I think the other thing that's going on is that because we're spending so much on CapEx, we're going to spend almost an 80% increase or over close to $800 billion this year in CapEx and AI. That would you rather own Meta in an ad business, or would you rather own the picks and shovels that go into building the data center? So the energy, all the infrastructure names, hardware, semis, and those sectors are absolutely ripping, right? The SMH for semis ripping. So I think you have a trade that's happening where the conviction is just lower in Meta, and therefore the money's going into Google, it's going into semis, it's going to hardware, it's going into energy. And so we're just seeing a more higher conviction level. We have confidence long-term in Meta. We think if the stock's cheap and we think they're going to do better than the street thinks. But right now, it's hard to kind of get investors excited based on the guide that they just gave for the second quarter.
It's interesting you note that it's an advertising-dependent business. It's not like Amazon, for example, which takes margin on goods sold, and AWS is so huge as well. It's interesting. Wall Street Journal says today memory chips are now one of the world's most profitable products because of AI. You don't really think of. I know memory chip stocks have been investor darlings.
Yeah, I think obviously in the AI trade, these AI agents are going to need memory. They need storage, they need compute. And so again, it goes back to kind of the gold rush days or building the railroads. Did you want to be the person laying the railroad track or selling the actual infrastructure? And so it goes back to the picks and shovels of memory, energy. Microsoft said they're physically constrained in physical buildings. They can't find the buildings to put these data centers in. So if you're in real estate, you're in power, you're selling memory, chips, hardware, liquid cooling, networking, you're thriving. If you're having to assemble all this, you're not thriving. And you're seeing those stocks, drive much higher based on that.
Alphabet, now, they're obviously advertising is huge for them, but they do have their big cloud business. Are you attracted to Alphabet right now?
We are. We think stock's going to 400. They absolutely ripped the backlog number for their cloud business. So the majority of the revenue is ad driven, but they also have an emerging what's called Google Cloud, which is effectively the infrastructure that you as a company can turn to them to power your back end services, your AI, and that business had the best numbers of anyone last night. It was the star athlete. It got the biggest trophy. The numbers were incredible. The backlog was incredible. And I think what they've said is, while you have this emerging cloud business, the ad business is showing right now amazing numbers, and they saw a record number of search queries. So the worry was a year ago that we're all just going to go to ChatGPT or Anthropic or name your favorite AI tool, and we're not going to go to Google to ask questions. Well, actually, it's caused the reverse. We're doing so many queries on these systems, it's creating more volume. And so they're actually seeing the number of search queries at an all-time high, because I think these tools have made it so easy for all of us to actually find the things that we want. And then you end up going back into Google. You may start at ChatGPT, you may start in Anthropic, Claude, but you're ultimately ending up back in Google doing the search. And then they have an emerging subscription business. If you look at YouTube TV, you look at what's happening with YouTube Music. If you look at what they're doing in the home and some of these home subscriptions for Nest, for the different services they can provision for your home. I look at this and I say there's not only an ad business, there's a cloud business, there's a recurring subscription business that Google has. They obviously have a call option on Waymo. If you've been to San Francisco lately, you'll see more Waymos than probably Ubers with no driver, right? And so you have all these emerging businesses that they have figured this out. To make AI work, you need users, capital, and data, and they have all three. And they're doing better than anyone right now in our coverage.
Thank you very much. We'd better go. Brent, thanks very much for giving us the insight and the time today.
Thank you.
Brent Thill, AI software and internet analyst at Jefferies Research. We got those opening bells next. There you have it, the opening bell action on Bay Street and Wall Street. At the NASDAQ, Avalyn Pharma is ringing the bell. At the NYSE, it's NASA doing the honors. It's time for the first 50. Let's check in on the equity markets as we get going on this Thursday morning. And you can see U.S. stocks are rallying. The TSX Composite up as well. A ton of earnings from the tech sector last night. The only real disappointment so far appears to have been Meta, but Amazon generally delivering a strong set of numbers. And Alphabet, it looks like investors were happy. Google profit jumping 81% with the cloud business booming. And Microsoft, it reported too, it now says Copilot has 20 million paid users. That's their AI program, up 33% from January. A couple of stocks of interest here in Canada. Let's have a look at Bombardier. Big cash flow from this company, and you can see the stock up a little bit in early trading. The company reported, according to the Globe and Mail, its highest free cash flow in nearly 2 decades during the latest quarter. And then let's have a look at CP Kansas City. And there was weakness in coal, and that helped to drag down their numbers. Their profit was down year over year. But on the conference call, they seem bullish about the impact of the Gulf War, certainly in terms of higher prices and demand for energy products. Let's have a look at some of these tech stocks south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, just remind us what's happening with Meta.
Yeah, Meta is having a pretty rough morning so far. Meta is the one of the worst performing stocks in the S&P 500. It was down 9% in the pre-market session. So that is a dramatic move for a company of that size. What happened? Analysts on Wall Street were largely unimpressed with how much money Meta intends to spend on building out its AI programs and AI infrastructure this year. So previously, the company had expected to spend at a midpoint $125 billion this year. That estimate is moving up to $135 billion and well ahead of what Wall Street had expected, which was about $123. So the amount of spending that Meta is embarking on is raising questions about whether or not the AI spending is going to translate over the long term into the kind of profit growth that has been kind of promised by these AI applications. And as a result, we have a number of Wall Street firms cutting their price targets on the stock this morning. So you see JP Morgan, Stifel, and Truist all trimming the price targets on the stock, and the stock is falling dramatically right now. Pardon me, dramatically right now, 9.4% on the screen. This is a big move lower for one of the biggest names in the S&P 500.
And Alphabet, though, investors seem happy here.
Yeah, kind of the opposite effect. This is one of the top performing stocks in the S&P 500, and for exactly the opposite reason. Profits are accelerating, and not only that, Wall Street was kind of delighted to see that the AI program and the AI capability that this company is building out is actually driving some reacceleration and some additional business in both its search and its cloud business. So as you mentioned at the top there, Andy, profits are up for this company, and Wall Street, what they have been looking to see and what investors have been looking to see is whether or not the tremendous investments in AI are going to actually pay out. And that seems to be what Google is promising here. So while Meta got a handful of price target cuts, Google's parent, Alphabet, had a handful of price target boosts, including at Evercore ISI and Truist this morning. So kind of complete opposite ends of the spectrum here for these two magnificent seven names.
Thank you very much indeed, Jeff. Have a good one. Jeff Morgan of Bloomberg. Up next, we are looking at currencies, and we've got Carl Shimada up after the break. Okay, we have the one and only Carl Shimada joining us now. Always great to see you, Carl. He's Chief Market Strategist at Corpay. Thanks very much for joining us.
Great to see you.
Parsing through the central bankeries yesterday in both Canada and the US, what was your big takeaway?
It's interesting. It sounds very much more cautious, I think, than markets were anticipating, and if anything, a little bit hawkish. Perhaps more so on the U.S. side than in Canada. But when you have three of the Fed governor or the Fed presidents dissenting against a decision in favor of opting for more hawkish language in the statement, and you have a lot of discussion about the risks that inflation could present on the upside. I think that's something that should tell us that this is a Fed that is not going to follow President Trump's wishes in cutting rates dramatically. And also on the Canadian side, we did see a very, very neutral statement, very, very neutral monetary policy report. But if you look at, Macklem's comments quite carefully, it does seem as if their reaction function might be tilted a little bit in the hawkish direction, meaning that if we were to see a rise in inflation pressure in Canada, that they might raise rates more quickly than if we were to see, continued softness and a continued downturn in the economy itself.
But higher rates, would they really be the right tool when it's commodity-induced inflation or Persian Gulf-induced?
Typically not, right? And that is the assumption that most of us are relying on at this moment, is that that Fed and Bank of Canada officials are going to look through this energy price shock, that they're going to follow the playbook that they've followed for decades in focusing on what's happening in the rest of the economy. However, there's one huge bugbear here, and that is that the world economy has been hit by a series of shocks in recent years, and that has led to a situation in which consumers and businesses, for that matter, are more responsive to inflation or to price changes, and may actually start to raise their expectations for inflation in the future. And so the biggest worry for central banks at this point is of an unanchoring in inflation expectations that leads consumers and businesses to start raising prices. If that were to happen, it wouldn't really matter where the inflation shock originated, because we would see it across the broader economy. And so, this means ultimately here that there is a risk that rates do, resume their climb at some point.
I guess central bankers are a bit like animals using intimidation behavior at mating time. They wave their antlers around. We're ready to be tough. Because as you say, if businesses and the public decide, well, if inflation's back, their job's going to be much harder.
Absolutely. And I really do think, so the old term for it is job boning. But, the idea is that psychological warfare is a very important part of a central bank's toolkit. It's very, very important to, not just, exert pressure on the fundamentals, but also to convey a message and to communicate very effectively with participants in the real economy.
What is your view on, say, the Canadian dollar over the next couple of years? This economic boom or stimulus that the federal government is spending so heavily on will take a couple of years to pan out.
That's right. I do think that, this is putting the Canadian dollar on a more stable footing. And I do think that, once we see this conflict in the Middle East sort of come to an end, whichever way it goes, I think that will give us the foundation here for a bit of a rally. And I think the key piece of evidence for that is the Business Outlook survey that the Bank of Canada released, I think it was last Monday, in which they're basically showing that, businesses are beginning to look through sort of the trade tensions. They're beginning to look through a lot of the negative headwinds, and they're turning slightly more positive on the direction of the economy. And I think, this is largely, or shouldn't, heavily to do with government policy, in the sense that, this is a pretty business-friendly administration in Canada. We are beginning to see efforts to, reduce those interprovincial trade barriers and regulatory overhead, and we have public spending that's flowing into sectors like the defense sector, which ultimately could help to propel growth. So I do think we're turning a corner, but that at the end of the day, it's going to be a very, very gradual lift, as you pointed out there.
If oil prices stay high, and there are warnings to that effect, the boss of Shell says these price increases could hold right into next year. That's great. That is good, broadly speaking, is it, for our GDP growth? I'm thinking, of course, we do import a lot of oil too.
Yes, it is positive for Canadian growth at the end of the day. On an overall aggregate level, we are seeing, increased export revenues, meaning that, provinces like Alberta are doing well, the provincial treasuries are doing well. We're going to see downstream effects as the revenues flow down to other sectors in the economy. But at the same time, there are distributional consequences. The reality is that for most of the country, oil prices are an input cost. They're something that they pay at the pump and that they pay when they're importing goods from the rest of the world. And so these two effects are going to cancel each other out to some extent. So, it is a positive for Canada. It is a positive for Canada, especially if we do see a renewed cycle of investment in the energy sector, but it is not an unalloyed positive. And then at the end of the day, I think, if you're sitting at the Bank of Canada, you are trying to sort of, bridge that divide between the two different sort of poles that the economy is going to be, again, oscillating toward.
Carl, give us a big picture here. We hear talk about the decline of the Western world and that economic gravity is moving to Asia. Longer term, would you think about putting more money to work in Asia rather than in Europe or North America?
I think so, yes. I think in general, investors should be far more diversified than they are. And I do see a lot of potential in the European economy, especially as, defense spending increases and more money is put to work within the economy itself. But of course, where are the growth engines in the world? They are in Asia, in Africa, Latin America. They're not necessarily here at home in North America. And I think, if I were to really boil that down, I'm not so much concerned about, Canadians being invested in Canada. In fact, there are a lot of great opportunities here. But the huge long position that investors have on the U.S. and the U.S. dollar in particular does strike me as an enormous long-term vulnerability. It has been the place to be for decades, but we should not expect that persists for the decades to come. And so, I do think that a diversified mix of exposures really, really does make sense.
Carl, thank you very much indeed. Carl Shimada, Chief Market Strategist at Corpay. Yesterday on Market Call, we were joined by Bruce Campbell, President and Portfolio Manager at Stone Castle Investment Management. His focus, Canadian stocks. His top ideas were Condor Energies, CDR in Toronto, Aecon, and Group Dynamite. Today on Market Call, it's Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners. Raymond James, the focus, Canadian and US large caps. Just ahead, Canada is being selected to host a new multinational defense bank. We'll have more after this. So it now seems Canada will be the location for the headquarters of this new multinational defense bank. And obviously that's going to provide some lucrative jobs. Let's get more from our CTV colleague, Jeremy Sharon. Jeremy, thanks very much indeed for joining us. So I'm just looking at a news release here. It has been confirmed that Canada will be the location for this bank.
Yes, exactly. Expected to create about 3,500 jobs, Andy. So to your point, countries were vying for this. There were big pitches to try and land this new venture, this NATO bank, if you will, that will offer long-term, low-cost financing to NATO members and allies for defense projects. You can look at some of the examples Canada has coming up in terms of long-term, significant procurement, fighter jets, submarines. We're talking about massive money here that will be able to flow potentially through this new financial institution in this NATO multinational bank. The big question now is, where does it land in Canada? Toronto, Montreal, Vancouver, and Ottawa, all among the considerations. That decision likely to be made next. But this also, Andy, points to a vote of confidence by the allyship, by NATO allies, by NATO members in Canada, at a time when we've seen U.S. President Donald Trump, the U.S. administration, cast some doubt in their commitment to NATO, if you will, or the future of the organization. And what we're seeing in turn is a commitment here that Canada is a safe place to land, a trusted place to land for this next venture. And so I think it speaks to the role Canada is playing in the NATO membership. And it speaks to the fact that Canada also has pitched itself as a member nation that can play a bit of a bigger role down the line.
It is interesting that the symbolism of that, that Canada is deepening ties with European defense partners. The Prime Minister has also announced plans for a new appointment for a former Cabinet Minister, Jonathan Wilkinson. Fill us in there, if you would.
Yeah, I mean, you just touched on deepening ties, defense ties with European allies. This is a role that will be a significant one, and it's being kind of upgraded. Until now, Stéphane Dion played the role as special envoy to the European Union. Now we see this standalone role as an ambassador to the European Union. Jonathan Wilkinson is a seasoned MP, cabinet minister, served under Trudeau, now under Carney. And has played significant roles in this government and is now being appointed to this diplomatic role where he will play a key role in Canada's position with European allies at a time when the Prime Minister has quite clearly indicated that he is looking to bolster relationships, bolster ties with European countries that already exist, create new ties as well. The Prime Minister is, quite focused on strengthening these relationships at a time when we know we have a review of CUSMA coming up. The future of this massive trade relationship between Canada and the U.S. is unknown. How significant that relationship will continue to be, or how it changes at least, is still unknown. And so as a result, we're seeing a Prime Minister and a government that are very focused on new relationships, on FaceTime with European allies. And this is an important appointment. Mr. Wilkinson will have a lot of work to do.
Thank you very much indeed, Jeremy.
Of course, anytime.
Jeremy Sharon, coming up, shareholder activism is up in Canada. AI is in the boardroom, and investors aren't willing any longer to accept vague answers from boards and management. We're going to break down Canada's 2026 proxy season after this. Are right back. Shareholder activist campaigns are increasing, and governance proposals have more than doubled, and investors are demanding more than just disclosure. They want accountability. So what are Canadian boards facing? What does it mean for corporate Canada? We are joined by Aaron Bowles, president of Kingsdale Advisors. It advises in proxy disputes and also, though, helps companies ensure their governance is shipshape beforehand.
That's right.
Great to see you.
Nice to see you.
So when we talk about a shareholder activism, a campaign, what do you mean generally?
Yeah, that's a good question. And right now we're seeing a heightened level of shareholder activism, more active than last year at this point in the season. So at Kingsdale, we consider the proxy season to begin at the beginning of August and end by July 31st. And so when we are seeing heightened activity, we're seeing trends like this, we ask why. And if you're trying to figure out why, a good question to ask is what? Like, what is the target? What kind of companies are in the spotlight? And what are shareholders asking for? And so what we've got here in terms of the activism is we are seeing more and more governance-related disclosure issues with companies. So who's on the board? Who's overseeing executive compensation? What is the skills matrix? So if you look at E, S, and G, E and S might have taken a backseat lately, but the governance part of who's running the company, how is it being, what is the skills matrix of the people running the company, what are they demanding of the executives, how is say on pay being adjudicated, especially where there's at-risk compensation. All of these issues are a little bit downstream from what else is happening in the culture and in the business community generally.
Sorry, what do you mean downstream?
Well, if you see that we live in a world where there's technological upheaval, there is questions about peace in the Middle East and other regions around the world where there is conflict, and you have an ongoing issue with, for instance, affordability, and you see stratification of income, you start to see that trickle down into corporate life and to corporate governance, where there are demands for, is the pay package that we have, that we are paying an executive, has that been properly vetted by the compensation committee? Or how are we coping with the intrusion of AI into every segment of life? We see it in our personal lives, we see it in education, we see it in the culture, we see it in families. Now we're going to see that at the board level in corporations. And also, whether or not you are future-proofing your company for a disruption that comes from its business model in general.
We've seen so many takeouts of companies and REITs listed on the TSX, implying that they're not attracting very good values in the public market.
Yes.
And that's going to annoy investors. So maybe that's a low valuation on Canadian stocks as a factor.
Sure. If we look at the categories of governance and the concerns that people have in activism, right now it is the smaller cap companies, we're talking $200 million or less, that are the largest targets of, we call them microcap, of activism. But we see activism at the mid cap and also at the mega cap level at $10 billion. But valuations are certainly at play in that lower level at the smaller microcap level. And some of the REITs, which were at one point trading at sky-high valuations, now are coming down. And that is usually a good recipe when you have valuation challenges for getting an agitation at the board level to change things. Who is overseeing this company? What are they doing to hold the executives to account? What does the strategy look like to create more value going forward? And where there is an impatience about that, you are going to start to see activism.
I was just curious because we have rules on governance in Canada that are different from the United States.
Yes.
And I asked you before the show, is it straightforward? Is it easier to be an activist in Canada?
Yeah, and it depends on what you define activism as being.
Okay.
So there's a certain kind of activism, and we've seen this, and you'll see it in Kingsdale's report, where meeting requisitions, which is where if in Canada, if you have 5%, if you hold 5% of the shares and you can verify that, you can requisition a meeting well before the AGM. And that sends a signal to the board that you represent a group of investors that is not happy with the pace of change. In the States, if you want to requisition a meeting, there is no clear 5% rule. It can be 20%, 30%, even up to 50% of the shares you have to hold before you can requisition that meeting. And that's a signal.
The Proud Brothers have certainly emerged as activists here.
Yes.
So we're talking about Matthew Proud. He heads Plantro, and he's been tangled up with Diane Durham.
For years now.
Yeah, and but he's also been putting pressure on Ag Growth International.
Yes.
Kalian, I didn't know that actually, Kalian and Diane Durham.
That's right. Yeah. This is ongoing. Well, and in those cases, what you have is, if you look at what happened with ISC, that was an agitation to have a strategic review. So, for instance, the board in that case, whether on their own or in response or just coincident with, a strategic review took place. If you look at Diane Durham, well, there's been all kinds of changes there. It's been board changes, it's been executive changes. And you look at Ag Growth, the issue there is this business model dead? Should the company just be sold for parts? Is there any viable path forward without a strategic review and a breakup or a sale? So again, you have valuations in some of these cases that are under what they think the peers are or what the market should be bearing, and you have impatient investors. And as I said, it's downstream from culture. We live in an age where people are impatient. They're impatient with peace in the world. They're impatient with where their paychecks are going. They're impatient with how they figure out AI. They're impatient with the competitive landscape. And the corporate governance landscape will reflect that.
Thanks very much.
All right, you're welcome.
Aaron Bowles, president of Kingsdale Advisors. Coming up, copper and silver producer Lumina Metals plans to hit the TSX with an IPO. We'll get more from the CEO. Welcome to the second hour of our show. Let's check out the big stories we're bringing you from our newsroom. The Canadian economy posted modest growth in February. StatsCan says GDP rose 0.2%, in line with expectations, following a smaller gain in January. The increase was driven by strength in goods-producing industries. However, early estimates suggest growth stalled in March. We're watching shares in GFL today. That's the waste management company. It posted first quarter adjusted profit that missed estimates. However, revenue was higher than expectations, and the company raised its revenue forecast for the full year. And let's have a look here at Meta Platforms. Stock sliding 10%. Wow, it's up only 9% in the past year. That's after the tech giant raised its AI spending outlook. Meta now expects significantly higher outlays this year. The company's first quarter results did beat expectations on both revenue and profit. But the company is focusing on the scale of that CapEx as the company builds out data centers and invests heavily in AI infrastructure. And there is the TSX. It's holding its own today. Let's have a look at those US markets as investors digest that flood of tech earnings that we got last night. The S&P 500 hanging in. You can see Meta is weighing on the NASDAQ there. Lumina Metals has just started trading on the TSX, just pulled off an IPO, treasury and a secondary offering that raised more than $400 million. They are working on producing copper and silver in Poland, and the company is backed by mining veteran Ross Beatty. We're joined by Jordan Pandolf, CEO of Lumina Metals. It's great to see you.
Thank you, Andy, for being here, and thank you for such a long and successful career covering the mining industry.
Oh, thank you. I love those miners. So you've just pulled off this IPO. It's big, and I know you're going to tell us how big, but 400 million. Almost 100 million of it, though, was Ross Beatty's Sitka Charitable Foundation.
Yes, Ross donated a number of his shares to the Sitka Foundation, and the Sitka Foundation participated as a secondary selling shareholder in the IPO, given the demand we had for this IPO was over 3 times what we originally went out with. We had some of the world's largest institutional investors from North America, from Europe, from Australia and Asia, as well as a number of well-known Canadian investors, including the Lundin family and Eric Sprott, who have been with us for over a year now.
So the stock is listed as LMCU in Toronto. So you say this is one of the biggest IPOs of its kind. You can see the stock holding its own in early trading there.
Yes, no, this is a new but old company. Ross, as everyone knows, is a renowned Canadian mining entrepreneur that went to Poland in 2011 and with his own work and the team of the Lumina Group discovered the 3 largest copper and silver deposits in Europe since 1957. So these are some of the largest copper silver assets in the world that are undeveloped today, and ultimately over 12 years and hundreds of millions of dollars that was spent discovering these assets. We have now become a public company, both in Toronto as well as we are preparing for a listing on the Warsaw Stock Exchange.
So Poland has a long tradition of mining and smelting, but I think people would be surprised to hear that it has world-class copper deposits.
Yeah, so in Poland, the geology is titled the Kupferschiefer, which is a style of mineralization that exists nowhere else in the world, given its characterization of such large copper, but also silver. There's more silver in the ground in Poland than any other country in the world. And when Lumina Metals is producing, we'd be the world's 3rd largest silver mining company.
So what's your plan? How many mines do you want to build ultimately?
So we have 3 deposits that we discovered. The IPO is funded us through the next 5 years of advancement and development work on our flagship project called Nova Sul, which is 9 million ton copper asset and almost 900 million ounces of silver. So we will take that asset through all of the de-risking and ultimately look to get our mining concession by 2030.
2030. Poles are known for their efficiency when they want to do something. Is the regulatory process quick there?
I can't speak well enough about Poland. They have such a long-standing history, as you know, 70 years of underground copper mining, but also coal mining. There's 100,000 miners in the country. and their processes are very efficient. And ultimately, when they want mines to get built, they make sure they do get built.
Right. So you were with Glencore for nearly 10 years. So what's your background? You're a financial guy, essentially. You're not a geologist or engineer.
No, I started my career actually at BMO in the banking side, and I worked for Glencore for 10 years looking after business development. I was based in Switzerland looking after copper, zinc, nickel, all over the world in terms of acquiring assets, selling assets, as well as investing in some of the world's most important assets.
What kind of capex are you looking at over the next couple of years?
So our IPO takes us, as I said, all the way to 2030. So we are fully funded to 2030. Once we have our mining concession to build these two mines, would be about $3 billion US for each mine, and each mine would be producing 150,000 tons of copper and 15 million ounces of silver. So once we have both mines built in full production, we'll be producing 300,000 tons of copper and nearly 30 million ounces a year of silver.
That's pretty serious copper production, a third of a million ounces almost.
Yes. These are world scale and world class deposits. Super giant
pounds, I should say. Sorry, go on, Jordan.
Yes, 300,000 tons. So over 600 million pounds exactly would be one of the largest copper mines in the world, and it would be the largest producing silver mine in the world once in production. So we expect there'll be with this IPO. A lot of activity from global investors, but also the world's largest mining companies that will put Poland on front and center on the map as the future of critical minerals production in the European Union. In Europe, they mine about 1 million tons of copper, but they consume nearly 4 million tons of copper. So the EU is short 3 million tons of copper. And as we know, in this day and age, critical minerals, especially in places like the European Union, are of the utmost importance.
Where do they produce all that copper? I know Spain does some, but where are the big countries?
So the largest copper miner in Europe is Poland today. Wow. They produce almost 500,000 tons of copper and over 40 million ounces a year in Poland today. And that's about 40% of the broader EU's production. So the EU will not have mineral independence without Poland.
That's interesting. Yeah, I should have said 300,000 tons plus is what you're talking about. And the world mines, last time I checked, maybe 20 million tons every year, maybe a bit more.
Yeah, exactly. So for the EU, Poland is such an existential place to go for critical minerals. And as we've seen with geopolitically what's happening in the Gulf, if you don't have energy independence, you don't have any independence.
The TSX will be your primary listing?
Yeah, today we will be trading, as everyone can see, in Toronto. We're also adding a listing in Warsaw, given we have a number of Polish investors that have joined us. And ultimately, given how such a large asset in Poland this is, we want to increase our presence in Warsaw, in Poland, and ultimately have a broader investor base in Europe and in Poland.
You didn't choose London. Was there any particular reason why you went with Toronto for your primary listing?
I think, given the history of mining development in North America, and specifically the TSX, this is a long-standing exchange that has a number of world-class investors. And ultimately, London's been in a bit of a decline over the last few years from a mining standpoint.
Yeah. Well, good news for Toronto because some listings have been bypassing our domestic market, certainly in terms of primary. Jordan Pandolf joining us there. Thanks, Jordan. He is CEO of Lumina Metals, just started trading today. If you want to check it out, the symbol is LMCU, I believe.
Yes.
Thank you very much, Jordan. Coming up, markets mixed this morning. We do have those volatile oil prices and some impressive reports from the mega cap tech names in the United States. We'll have more after the break. Let's get more from one of our favorites, Ryan Bushell of New Haven Asset Management. Great to see you, Ryan.
Thanks, Danny. Thanks for having me.
My last day, thanks. And we've been talking for years.
Yeah. It was I had to come in and see you today to say goodbye properly, and definitely appreciated everything you did for me over the years when I was pretty green, learning the ropes here. So
thank you very much indeed. One thing that's jumping out for you lately is these energy deals in Canada. Shell, for example, buying Arc Resources, big bet on Canadian natural gas.
Yeah, and I think it's more a bet on the infrastructure side, right? So it helps them to backstop LNG Canada Phase 2. We were talking off air too about the Pembina gas infrastructure deal with Apollo coming in. Now, you usually don't see one large US PE firm selling to another large US PE firm. Usually they're looking for an exit or a clean exit. But I think both of these deals show the interest in natural gas export infrastructure from Canada. And I think that is a big story to play out here. You know, the Strait of Hormuz crisis, everybody's talking about oil, everybody's watching the oil price. 20% of the world's LNG is offline right now in Qatar. That's, to me, a more acute crisis. The storage and transportation of natural gas is much tighter than it is for oil.
Let's pop up a 5-year chart for ARX, I think, and PPL as well. So that's interesting. Apollo is coming in buying, I think it's a third of this gas infrastructure.
Yeah, 40%.
40%, sorry.
Yeah.
But the seller is KKR.
That's right.
And what did you say, USP? How did you describe
US
this?
private equity.
Oh, US private equity.
So
sorry,
you don't usually see them, trading horses, so to speak, one to another. Usually they're looking to offload to maybe, say, a pension fund. And there certainly will be secondary deals on the back of this. But that was an overhang for Pembina Pipeline because they own the other 60% of this company. And it's a lot of sort of capital JVs that they're able to put more money to work than raising equity from their shareholders. So it's a good deal for Pembina in our view. But I think both of these deals show, again, the ARC Resources deal is bittersweet for us. We're big holders. And so, to get $32 for it or wherever it's trading.
You would have liked more?
I would have liked more. I was surprised the board agreed to it. It must mean that the Attachie project is worse than people.
That has stumbled, yeah.
Yeah, and so for them to take that deal, especially taking that much stock, I was surprised, but you have to. There are other opportunities to move on to. So we're going to be doing that. But I think the bigger story here is what's ahead for the basin. Like if you think about LNG Canada Phase 2 and potentially the Kyle Sims, I'm pronouncing that wrong, I'm sure, project as well.
Oh, right.
You start to get
the
to
LNG export thing.
That's right. You start and Cedar LNG, which is coming on next year, hopefully. You're looking at sort of 5 BCF of incremental capacity in a 20-ish BCF a day market in Canada. So you're talking about, 25% expansion to export capacity over the next, call it 5 to 7 years. That's material for all of our companies. We've had AECO just as recently this summer, which is Alberta gas price,
local,
trading at $1 an MCF Canadian, right? Which is pretty poor.
Oh, yeah.
If we get that up to $2, $3, $4, somewhere in that range as a floor, it makes all of these companies, much more robust. And I think that's what Shell sees with ARC.
Yeah, natural gas is so funny. When it gets stranded in Texas, apparently they're paying people to take natural gas off their hands.
Yeah, or flaring it, exactly. Yes, so it is regionally constrained, but there is demand. There's ravenous global demand if we can have a surety of supply. But events like the Strait of Hormuz crisis, there's been a cyclone in Australia that took some production offline. Even these U.S. LNG facilities have outages from time to time. The security of supply has been difficult over the past few years, and so what the world needs is more points of supply, secure points of supplies to be fungible for one another. And I think Canada has a big part to play there. We missed our first opportunity 10 years ago when the U.S. built their first kind of 15 BCF a day of export capacity. They're building another 8 to 10 right now. Like I said, if we can build 5, I think it'll be well utilized. We have so much to offer on that side of it, especially given the lower price cost of our gas, the better cooling temperatures, so less cost to cool down the gas because it's cooler here than it is in Louisiana, and a shorter shipping route to Asia as well. So a lot of things going in our favor.
The semiconductor stocks, I know it's an abrupt pivot, but and chip stocks generally, memory chips, investors piling into those. What do you think?
Yeah, I would just be very cautious. I mean, not just based on, the historical examples of Cisco and Nortel and going back a few cycles to, let's go back to the railroads in the 1800s or the automobile manufacturers in the 1920s. Any new thing tends to get overbuilt. Now, there are actually some very big energy connections to the semiconductor industry. The first is with the Strait of Hormuz closed, these semiconductor factories are facing shortages as well of certain critical elements that they need for manufacturing.
Helium
especially. And the other thing I keep looking at and being a bit puzzled by is look at the NVIDIA sales numbers, okay, however many chips they sell. Each one of those chips is like a person from an electricity consumption perspective. So if you think about them adding, millions of chips, that's like adding millions of people in terms of power demand. We just literally can't build the power fast enough to power all these chips. So I do wonder at some point whether orders will slow down based on that physical constraint. It's becoming a physical constraint. We had years of Moore's law, twice the computing power with half the energy. It's not that that's not happening anymore, but the computing requirements are growing so exponentially that now it's pulling the energy with it. And so, again, I think that there's if there's not a psychological or just basic market bubble wall that it hits, there is also an energy wall there that's out there somewhere, and we may already be past it and just not know it yet.
One last stock, Premium Brands, PBH. We've been talking about it a bit on the channel. Huge in specialty food, Philly cheesesteak, shrink wrap sandwiches. I'm getting hungry now.
Yeah, me too. So the big deal they have is premium meat products into Costco. So this is what's changed with the company over the past sort of 5 years. They've been working on this, proving out their product line, and now Costco has basically said to them, we're ready to take capacity. Well, the problem with that is that when you're a big US, like the size of US Costco versus the size of the Canadian premium brands previously, it was a mismatch. They just didn't have enough capacity to fill those shelves. So they went on a capacity building exercise over the past 3 or 4 years. And this is very akin, we were talking about Enbridge 5 or 6 years ago, or even longer when they were building the Line 3 replacement. And everybody was saying, oh, they don't have enough cash flow. They're taking on all this debt. And it's like, well, they're building one of the biggest capital projects in their history. And when that comes online, it's going to produce cash flow for them for the next 50 to 100 years. It's not that different for premium brands. They had to build a pipeline. They have a willing customer. They have a customer that's willing to take the offtake. They just had to build the capacity to service that customer. And now that that's done, we do feel that will be beneficial to them over a number of years. And that's before we talk about the innovation they have on different products and getting new products to market that consumers like with their specialty background in terms of buying different specialty foods makers. And it's a really good management team. So we're pretty excited about it. It's come off on the energy worries, consumer pressure, et cetera, but you don't see a lot of consumer pressure in too many areas if you look at the retail sales numbers and other luxury goods items. So I actually think, it's a pretty good opportunity right now to be looking at it.
Ryan, thank you very much.
Thanks, Andy. Congratulations, and wish you all the best, man.
Thank you very much. Ryan Bushell, Chief Executive Officer and Portfolio Manager at New Haven Asset Management. Coming up, today's ETF report. We're going to have a look at cannabis. There's a couple of ETFs out there amid growing optimism over U.S. liberalization when it comes to the drug. We'll be right back. The Americans are moving towards liberalization of cannabis. It looks as though the drug is going to be placed on a less stringent schedule in the United States. Of course, it's been legalized at the state level, many states, for years, but not at the federal level. Now, in theory, this is going to be great for cannabis investors in equities. Let's have a look now at HMMJ. This is a long-standing ETF that tracks the marijuana equities. Now, it was launched almost 10 years ago, and it's been tough for investors in the marijuana space. Not sure if we could show a 5-year chart. Since its inception, if you had put $10,000 in, according to the company's latest disclosure, as of March 30th, today, you'd be looking at only $2,500 right now. So you would have turned a $10,000 initial investment right down to $2,500. We had a look at a 1 year there. Maybe you can have another look. The big hold, it's not a big ETF, only about $41 million in assets. And there's the 1 year. You can see it's bounced off the bottom lately, but we've heard these stories over the years. Oh, America is going to move decisively to legalize cannabis, and never happened. So the big stocks in here are Canopy Growth. That's number one. at about 10%. This is about a week ago. Then SNDL, then Kronos Group, and then Jazz Pharmaceuticals and Tilray. Those are the five, or among the five big holdings in this one. So there you have it. I'm not sure if we could put up a couple of, yeah, thank you very much. So we're comparing it there to two companies that have U.S. exposure, and you can see they have done better over the past year than HMMJ. Both have got a lift lately as the U.S. very slowly turns to adopting less punitive attitude to cannabis. That's your ETF report today. Coming up, we're going to get more investor reaction to big tech earnings. We'll be right back. Shares in Bombardier jumping 10% after the maker of business jets posted strong first quarter results. Both profit and revenue were up. The company said the results were driven by deliveries as well as strong demand for maintenance and support work. Now, there was a rebound in free cash flow, and the company raised its full year forecast. Shares in Gildan Activewear up about 7%. The maker of apparel, including t-shirts and underwear, posted first quarter results that beat expectations, and revenue came in at a record $1.2 billion. That's after the acquisition of Hanes Brands. Gildan says the integration of Hanes Brands is on track, with higher savings expected this year. There's a look at GFL Environmental, slightly down today. This waste manager posted first quarter adjusted profit that missed estimates. Revenue, though, was ahead of expectations, and GFL is raising its revenue forecast for the full year and boosting its earnings outlook. We're going to get more insight on the quarter when we speak with GFL's CEO and founder at 1:40 p.m. Eastern. He'll tell us how GFL is setting itself up for the year ahead. North American markets on your screen there. You can see the disappointment over Meta's continued massive spending on AI. It's been weighing on its stock today and helping to push down the Nasdaq. The S&P holding its own, and Toronto is higher as well. Let's get back into those tech earnings. Microsoft reported better than expected results, but it did tell investors that capital expenditures this year will reach $190 billion US, partly because of soaring memory costs. You can see the stock is taking a haircut now, down about 5%. We're joined by Dan Rahinton, portfolio manager at IA Global Asset Management. Great to see you as ever, Dan. Thanks for joining us.
Good to see you, Andy.
So it looks as though this rush to buy things like devices, electrical capacity is running into cost inflation.
Yeah, and on top of that, it's important to remember for this company, it's not just this year. Next year is likely going to be even more so in terms of the CapEx spending. So it's not just that there was, call it bill of materials, inflation, memory, CPUs, things like that did increase CapEx. Mm-hmm. Next year, the expectations that the CapEx intensity is going to keep rising. But I think it's important to take a step back. It's for good reason. And it's a good news story for all of these companies, because what Microsoft did say on the call was users are using Copilot per week almost as much as they're using Outlook, which is a very, very dominant application from the legacy Microsoft suite. And then they're going to launch a new suite of products called E7. So basically all the Office tools you have plus basically Copilot, and they're going to charge a per seat model and then overage, basically. So cost plus on the broad Fortune 5,000 that Microsoft serves. So I think it's actually a good news story, and I think the stock's an interesting bargain today.
So yeah, that's interesting. What about Alphabet? Investors seem to love those numbers.
Well, you know, it's funny. Early last year, you'd be having the opposite conversation with Alphabet. You'd be saying, search is going to get disrupted. Things are slowing down. Google Cloud is never really going to make it in the same way that Amazon and Microsoft have. And here we are today. Google is putting out a pretty clean quarter. So Google Cloud was very strong, exceptionally strong. Google Search was very strong. And ironically, YouTube was the weakest. And I think this is one of those companies where I'm more of a seller today than I am a buyer. But on the back of what I think was an exceptionally clean quarter after a string of clean quarters on the part of Google.
Let's have a look at CP Rail. Would you be a buyer of that stock or CN Rail? Which one would you favor right now, Dan?
Yeah, I think it's interesting because I would actually look to a UNP, the big Transcon merger, that transcontinental rail merger that's coming down south. But if I had to pick between CP and CN, I would go closer to CP today, primarily because there's more. First, I think it's important to talk about the quarter. I think it's more of a kitchen sink quarter than anything else. They've missed basically on every metric, but the incremental guidance from where we sit today was actually broadly positive. So expecting basically yield improvement, some OR leverage, a continuation of the buyback program on the part of CP, on the back of what should be tightening transport markets, which is what we're seeing from the truckers. Think of your Transforces, your ODFLs, your ArcBests. They've been putting up good numbers, which means volumes for the rail should come at some point in time. So I'm a buyer of CP today, but it's really picking between three relatively good news stories. But, this is one of those things where it is industrials, it is sensitive, so things could turn on a dime for the rails, just like it could for the trucker. So I am a buyer of CP, but I'm a little bit more excited about Microsoft today than that stock.
Dan, you have long been following the auto industry. Give us your latest take on the possibility that people will buy more hybrids or even electric cars because of the rise in gasoline. I mean, I know these things are slow moving, these trends.
Yeah, what's interesting, Andy, is when I take a step back, I think the real story in autos is going to be the integration and the melding in together of what used to be called the Internet of Things, the IoTs from back in the day. So I think what's more interesting today isn't really going to be the shift between basically combustion engines to EVs on the fuel savings, because you need the belief that fuel prices are going to stay elevated for a prolonged period of time for that to make sense. I think the biggest shift that the auto industry is going to face is going to be the likes of Waymo, the likes of Zoox, which is the Amazon-backed self-driving startup, and Tesla full-service driving. I think that's really where the big moves are happening in the auto industry, where the idea of owning a car is not going to be so sacrosanct as it was back in the day. And we're seeing that a little bit in younger people not deciding to push off getting licenses. But the real story is going to be the idea that you need a car in the first place. And self-driving, I think, is seeing tremendous improvements in adoption. And I think that's really where we're going to go from here. And at that point, you stop caring what the price of fuel is, because it really becomes a variable cost for maybe Waymo, Uber, Zoox, or any of these other fleet management companies.
That's interesting. But of course, we could see far more cars on the road, couldn't we? Because people will have a regular one and then a little self-driving car to pick up the kids or something.
Well, it's funny. I'll actually take the other side of that just in the interest of debate and discourse, right? If most cars are parked out. For myself, I own 2 cars. They're both parked right now. The vast majority of cars are used maybe 5-10% of the time.
I guess so,
So you don't really need it anymore. It's just that taking the bus is a lot more inconvenient. So having a fleet like Waymo has in Austin, they use 1/10 of the cars that you would normally use. So that type of fluidity, the idea of car ownership, because the cars tend to be this black hole where the money just goes in, whether it be insurance, whether it's financing, all these things. I think the real downstream effect is going to be car ownership rates are going to fall, and it's just going to start slowly, but over time it's going to start picking up steam. And I think that's going to mean a lot for car manufacturing, the insurance companies, and frankly, how cities are constructed as a whole. So big change is coming, but it'll take 10 years.
Dan, thank you very much indeed. Dan Rohinton, portfolio manager at I8 Global Asset Management. When we come back,
congrats on your career, Andy.
Dan.
It's been wonderful working with you. So all the best in your golden years.
Dan, thank you. Oh my God, the twilight years. Yeah, thanks very much indeed, Dan. Dan Rahinton.
Take care, Andy.
When we come back, we've got hot picks in oil and gas. We're going to be joined by Cole Smead. Time for hot picks. Today we are looking at 3 Canadian energy producers. And we've got one of our favorites, Cole Smead, CEO and Portfolio Manager at Smead Capital Management. Cole, it's great to see you. Thanks very much indeed. Before we get into the individual stocks, you reckon the market, the energy market is underestimating this supply disruption from the Persian Gulf and how long or severe it'll be?
Yeah, and before I get into that, Andy, I just want to say congratulations on a wonderful career on behalf of all my colleagues and the thousands of Canadians that spend their time here in the desert every winter. And so we owe you a drink, dinner, or a round of golf whenever you'd like. So
I'll be there. Thank you.
To your point, Andy, the answer is unequivocally, if you look at global indices, we're sitting at, 3 to 4% sitting in this space. And this is a rude awakening for investment markets. If anything, investors thought this was going to be adorably cute like Venezuela, and they found out that this is a 60-day stalemate so far. And the time needed to actually get boats to Asia with this crude is going to be 30 to 40 days out. So there's real world implications going on. And, watching, it's even interesting to see like the ARC purchase go on this week. With them getting taken out, people are thinking, oh, it's a 30% premium. This is great. Well, if you look at ARC's performance, ARC was not one of the winners. And I think I have a piece out today talking about the idea that the real winners in all this are the oil names. They continue to be. And if you look at the futures market, the contango there that investors are willing to bet on isn't as valuable. Looking into backwardation for years argues supply is going to be tight for a very long time, and it requires a lot of faith. And that's really what investors have been missing time and time again in this space.
Let's get into some of your stock ideas. CVE, mighty player in the oil sands. And of course, this bodes well for the oil sands, really, if people are questioning security of supply in energy.
No question. No question. You got long reserve life in these assets. It's something that, they haven't been as excited about up until really late last year. And then you're really seeing the strength of this come to pass. The MEG purchase, it just looks fantastic right now. They're going to increase production into this environment. That looks great for them. They'll use the NOLs from MEG, which has worked out to their favor. You're seeing them buy out preferreds. You're going to see them do buybacks. That's all great. If anything, this is a tailwind that also feeds the downstream business. I've been critical. We've been critical on the downstream business because we think the best businesses are pure upstream. That being said, the reality of the math is that the diesel crack spreads right now are literally minting downstream. And so that is going to feed Cenovus in a way that it doesn't some of the other independent producers that don't have a downstream asset like that. So that's all to their credit. But again, this is a new all-time high in the stock. And I just don't think we're going to see the period that we saw prior where, people are going to be worried about the oversupplied market. We're going to have to build up supply for a few years here.
And just walk us through what you said about backwardation there again in the oil market, because I want to make sure I had it straight. Right now, we have a situation where the futures are a lot lower than physical prices. So what is that telling us again?
Yeah, spot today is high. If you go 2 years out or more, you're at $70 or lower per barrel in the futures. Now, admittedly, just so your listeners know, there's not much volume as you go out the futures curve either. In other words, you can't go out and trade that a lot of volume. Can one of the big producers go out and trade 5 or 6 years out? The answer is no. So I don't think that's not a very good physical guide to a hedging what they can potentially do. Also, if you go back, Andy, is this a good predictor of the future? It's not. It didn't predict Iran. It didn't predict Ukraine. And so people use it as, they'll look and say, well, what's mid-cycle? Oh, is the middle of the curve moving? Mm-hmm. That's what, the last 2 years these stocks have moved on. If that moved down, they trade the stocks down. And the only problem with that is go look at the Baker Hughes rig counts. Rig counts are down 8 to 9% in the United States the last year. Has spot been pretty nice for those producers? Yes. So what are we learning? We're learning that the industry has been trained into not misallocate capital. to not waste it on frivolous CapEx spending. And we're seeing that play out in the open market right now, where even very high spot prices relative to the recent past or history are not causing them to go out and drill. Now, comparatively, if you look back at the 2010s, you had contango. So as an investor, let's just say I knew nothing about the companies, I knew nothing about the environment. I just know that in contango, oil companies lose money. And in backwardation, oil companies make really good returns. I mean, 5 years looking back on a lot of these, it's 40% compounded. What would I rather have? I want backwardation. Does it require faith? Yeah, I have to look into the whole of 70 or less 3 years out. But you know what? Faith is where the big money's at.
Backwardation, of course, where the futures price is lower than the spot price. Sorry, we've used up a lot of time. Strathcona is another stock that you like to look up. Cole, walk us through that, if you would.
Strathcona might be the cheapest name in the space right now. If you look at their total capital they have running the business, about 1.3, trades for 1.3 times its total capital. They are unhedged. They're going to be going at this and watching revenues month to month in March and April. They're probably running 80% higher revenues per day than they were running to start the year. And so what I think the street is going to have to do is the analysts are going to sit down and say, okay, cool, what if we stop this today and go to $70 oil the rest of the year? You're going to see returns on capital in these businesses of 25 to 30%, even if we drop to 70% or $70 prices. Now, what is that relative to the multiple? If you make 25 to 30% returns on capital, you don't end up trading at 1.3 times your total capital in Strathcona's case. So I just say that because they remind me of a stock that got a lot of love last year, has cooled off relative to other players this year. But I think people are going to have to buy the stock because of the attractiveness, the capital allocation. And I will add one more thing. On my recent visit to Calgary, Adam and Connor and I were joking around about this, but Andy, no one is saying that these are the good old days, right? Oh, the good old days, the good old days. These are the good old days. This is a golden era in the history of the energy business, and it is not going to stop right now. And people need to buckle up.
Finally, Tamarack Valley. We're very tight for time. What's your verdict on that one?
Yeah, vote against the board recommendation for a poison pill. Great management, bad board idea. Vote against Proposal 3. It's a really bad idea. And if you have any questions, find me.
Okay. As good as there could be money to be made in the takeover of this company, Cole.
Yep, I totally agree. They should be merging with Headwaters unequivocally. Tis the season.
Thank you so much. I really appreciate it. And when I'm down in Phoenix, Arizona, I'll give you a call. Thank you very much.
Do.
Cole Smead, CEO and Portfolio Manager at Smead Capital Management. Coming up, one last look at the markets. Let's have a look at the North American markets before we go. And you can see the NASDAQ still feeling some pressure from the selling in Meta and Microsoft. In Meta's case, of course, the massive spending that Mark Zuckerberg plans to continue on artificial intelligence. It does seem like a bit of a deja vu because, of course, a few years ago, he was spending massively on the virtual world, and that worried investors. And we've also seen a bit of pressure on our friends at Microsoft today as well. And just looking at Canadian stocks, the TSX, you can see, is up around 1% right now. So it is advancing. Active stocks, including Whitecap Resources, slipping slightly. Baytex down a little bit as well. So some weakness in some of the energy stocks today. I see ARC Resources holding its own, though. Today is my final show on the Open, but tune in today at 3 p.m. Eastern or noon Pacific for my very last show on BNN Bloomberg and a farewell send-off on commodities as part of the ceremonies. This past weekend, some of the directors here at BNN Bloomberg took me out for a glow-up to get a haircut, a shave, and some nice, relaxing, hot facial wraps. And I was in ecstasy. They brought along a camera to capture the fun and some key memories over the past 25 years. Traditionally, a business guy would be traveling alone. Well, it first came to Canada in 1986 on a kind of exploratory mission. and I'd heard a lot. And it's funny, I was like some silly mid-20s. I had no idea of anything, but I had heard of Trudeau, the elder. He had quite the impact. It's funny, I don't know how I got hold of him, but he was quite an image builder for Canada, I think. But I got the sense, if you want to work in media, go to Toronto, which is a big place, the biggest. And so that's where I went, yeah. And I had worked on newspapers as a sub-editor, and in those days life was easier. They still had copy editors. And when I came to Canada, I worked for the Globe and the Burlington Spectator, just freelance editing. And you're like, oh, I think you're... She had set up this really nice sequence for the top of the show, you know, just showcasing what we had, and it was in order, and it was all connected to this biz that she had cut. But I, of course, started putting things in the wrong order. She got so impatient, finally, she said, just read the prompter, you moron. I at least once arrived at work over the 25 years, bleeding from crashing the bike on the way. Nothing too dramatic. The scariest I ever had was... Oh my God, this is looking totally weird about it.
It's mummified.
Oh, I love it. Oh my God, just leave me like this. 25 years is a pretty wide range of things that have happened. It's sort of like a bell jar, a bell graph or bell curve. You know, normal days, most days, but then there's some extreme events at the two ends, yeah.
Like you've missed the top of the show a couple of times, for example.
Yeah, I have, yeah. It's a disease. Unpunctuality, it is a condition. I would not last in like Norway or Holland.
With the most recent example...
Oh, thank you, man. Thanks, man.
The most recent example of punctuality, of course, would be today for this appointment.
I'm sorry. Yeah. Pardon me.
Oh, how's it looking there?
I think. Oh, I'm loving it.
Buddy, it never looked better.
Whoa. Just a bit of color now. Get out in the sun for a couple of hours. Oh, that was wonderful. Thank you.
Enjoy your time with us.
That was great. Yes, thank you.
Oh, nicely done. Nicely done.
Nice. Yeah.
Flippers and tickers. You've been asked a million times, what's the number one thing you're looking forward to in your retirement right now?
I think maybe opportunities, you know, just bits and pieces, maybe even community theatre. Yeah, I'm just looking forward to traveling and cycling around the country, maybe taking 2 or 3 days very easily, you know, especially midweek. I'm trying to figure out other ways to eat red beans because they are the #1 food for antioxidants.
You currently have a jar of Marmite in your side desk table.
Yes.
That may or may not have leaked.
Oh, yes, it has leaked. Yes. It fell on its side and I just hadn't put the lid back on.
Fine.
Yeah.
You're retiring in a couple of days.
I know.
I would leave it.
I know. I've got a lot of it wiped up, but it's hard.
Maybe whoever's sitting in for you next will enjoy Marmite as well.
I know. Maybe I should burn the desk or something. Yeah.
Start from scratch.
Oh, this is great. I'm going to watch more movies because there's so many thousands of good movies I haven't seen. So
Classics or modern?
No, classics. Also just silly modern ones. My thanks again to the directors for taking me out for that fun day. Thank you very much indeed for watching The Open. I'll be back for commodities at 3 p.m. Eastern Time or noon Pacific for my last show here on BNN Bloomberg. Okay, we got Roger coming up next with Morning Markets. Thank you for watching.